Namaste, welcome to Arthaniti, where we discuss money and money related tools to help you in your everyday investment decisions. My name is Dr. Shefalika Gokhale. I hold a PhD in business practices of mutual fund houses. So, what are we discussing in today's video? Well, tax saving, tax planning is one thing which we cannot ignore as March end approaches. Tax is a major slice that we have to pay to the government from our income. So, proper planning and execution of investing into various tax saving schemes is a matter which cannot be ignored and cannot be put further than this, right? So, in today's video, we will discuss one of the best tax saving schemes that is available to you in the market, why that scheme is the best, what are the returns as compared to other tax saving schemes, and why you should opt for this particular scheme is what is the topic of today's video. Section 80C of the Income Tax Act is a very important section under which you can invest in various tax saving investments and claim a deduction up to 1,50,000 rupees. Now, each of these instruments have a different lock in period, and the kind of returns that they generate also differ. Of all these instruments, traditionally people used to invest in PPF, National Saving Certificates, tax saving fixed deposits were the options that people used to explore, correct? But there is of late, ELSS has been the flavor of the season when it comes to tax saving. ELSS, which is equity linked saving schemes, is basically a mutual fund with a lock in period. Now, this mutual fund invests your money in equity markets. What happens is, with a lock in period of 3 years, you are invested in the equity market for a period of time, which helps generate returns which are better than the traditional tax saving instruments. Right now, when it comes to stock market, many people are averse. They think it is the most riskiest of options wherein your hard earned money can go. They it also, like, people stay away from the stock market. Why? Because they believe that it is like a gamble and they might lose all their money. One major advantage that ELSS has over other tax saving options is the lock in period. It has a lock in period of 3 years. Now, compare it with other lock in periods, say of a PPF, which has a lock in period of 15 years. Correct? National savings certificates and fixed deposits, tax saving fixed deposits, have a lock in period of 5 years. Whereas if you go for a NPS investment, National Pension Scheme investment, the lock-in period is till you attain 60 years of age. So compared to all this, ELSS has the lowest lock-in periods of only 3 years. See, normally when you invest in an equity mutual fund, it is taxed. Now, if you hold the mutual fund for a period which is less than 1 year, it attracts a short term capital gains tax of flat 15%, no matter what tax bracket you fall into. If you hold the mutual fund for a period of more than 1 year and then sell it, long term capital gains tax is attracted. Now, for the first 1 lakh gains, there is no tax. So, up to 1 lakh, it is tax free. Above that, what happens is 10% long term capital gains tax is charged without any indexation benefit. But for ELSS scheme, it, even though it is an equity oriented scheme, it is tax free. So you get tax benefit when you invest in a ELSS scheme. Right now, what is the kind of tax benefit that you will get with these investments? Say, suppose you fall into the highest tax bracket and you invest, say, 1,50,000 rupees in ELSS in a particular year. You can get benefit of nearly 48,500 rupees in your tax with these investments. Staying invested in equity markets for long term period, 3 years is the lock in. So if you stay invested for a long term period, what happens is the volatility in the market is discounted. Over a period of longer term, the returns that you generate in equity markets far are far beyond what you can generate with any other kinds of investments. With the magic of SIP, you can start investing in an ELSS scheme at the beginning of the financial year with as small an amount as rupees 500. Right, so over a period of time, when you keep on investing, say every month, twice a month, as and how you set your SIP, it gives a regularity in your savings and investing pattern. And no matter the volatility in the market, the rupee cost averaging, which is one of the key benefits of SIPs, is what you get advantage of, right? So ELSS is one scheme that you cannot ignore if you are planning for taxes or investing for tax saving. While investing in an ELSS, you can always opt for a direct plan. Why? Because of the lower expense ratio, which reflects in higher returns in your scheme. Last but not the least, this year you will have to decide whether you opt for the old tax regime or the new tax regime. The default tax regime, if you do not give your option, is going to be the new tax regime, under which the benefits of section 80C will not be applicable. So it has to be kept in mind that you will have to opt for the old tax regime if you are planning to invest, or if you have already put your money in the ELSS schemes, correct? Weighing in on the benefits, the lower the tax that you pay, weighing in on that while deciding on the two regimes is what your decisions should be based on. Again, let me reiterate, if you opt for the new tax regime, you will not get any benefits under section 80C. If you compare the returns that the various ATC investment instruments have generated, PPF gives you a return of 7.1% for a 15-year lock-in. National Savings Certificates give you a return of 7.7% for a 5-year lock-in. Bank FDs have a rate of interest varying between 4 to 7%, right? Again, for a 5-year lock-in. Compared to all this, according to Value Research, equity linked saving schemes, ELSS mutual funds have generated returns nearly to 16% for the last 10 years. So, in comparison, the lock in period is the lowest, the returns are the highest, and the exposure to equity markets gives you an opportunity to beat inflation and earn higher returns than any other investment instrument will give you, right? So opting for ELSS is a smart choice and the best tax saving option that you can put your money into. I thought of making this small video. Why? Because tax saving season is coming to an end, and if you have not done your tax saving, this is the time to do it and take advantage of the various provisions of the Income Tax Act to reduce your tax burden. If you have any queries regarding this video, please feel free to comment below the video, and I will be happy to help you. Please like my video and subscribe